Hey, good evening, everyone. Marty Mazzora here. It's Thursday, May 12th, 2022, with your economic update. Today I'm going to do another, just a really quick this time, update on the equity market, looking at the S&P 500. So in front of you is our what we call our PWA index. It's 46 data points. It's designed to give us a feel for probabilities relative to expansion, recession, overall conditions. And it came in flat week over week at almost 11, 10.87. We did have some offsetting moves among the inputs, and I'll jump to those right now. Mortgage purchase applications, second week in a row, we've seen a decent increase. So that, relative to economic conditions, would be viewed as optimistic. Jobless claims up for the second consecutive week to 203,000, but we are talking phenomenally low rates on a historic basis. Continuing claims were actually down. There's a delay of a week there, but they were down again for like the fifth or sixth week in a row, I think, but down, down certainly week over week. And so again, folks, it's tough to talk about high recession risks when we have such a tight labor market. I'm going to give you more on that here in a second when we look at what small businesses are saying about their prospects going forward. And here we are. Small business optimism was flat month over month, but certainly continuing to roll over. Overall, again, a pessimistic sound to the survey. However, hiring plans are still relatively high. I'll talk about that in a second. I'm going to read from the survey. CapEx, capital expenditure plans, expansion plans actually ticked up a little bit. I have the report on a separate screen here, and I'm just going to kind of read from the summary. Small business owners are very pessimistic about sales and business conditions in the second half of the year. This dampens capital investment and eventually will feed into employment if sales actually slow as expected. Financial markets have already made significant adjustments to changes in Fed policies and uncertainties of war and COVID shutdowns that continue in China. More is likely to come as assets, financial and real estate are highly overpriced. Trying to catch up runs a growing risk of overshoot. Hopefully that won't happen, and they're talking about the Fed with that last sentence. Now, on the same page, small business owners continue to try to fill their record high levels of job openings, but are finding it difficult. I can pretty much stop there with that paragraph. Small business owners continue to try to fill their record high levels of job openings. So I know you can see the contradiction there. Very pessimistic first sentence of the previous paragraph that I read to you. And then again, small business owners continue to try to fill their record high levels of job openings. I'm not questioning what small businesses are reporting. I believe that they're very pessimistic. At the same time, when I just take that as I read it, there's a real contradiction there. How can you be very pessimistic about sales and business conditions and believe that it's going to get worse in the second half of the year and be desperate to hire people? And other parts of the report say that they're really aggressively raising wages to try to attract people. If you're really pessimistic and you think we're on the precipice of recession, well then probably not interested in hiring a bunch of people. So there's probably more to that underneath the surface that makes sense of that. But if you take it at face value, it's a contradiction. I will say again, though, our conditions index is slowing. But when I look at the labor market, I'm having a tough time with the recession calls right here. I get where people are coming from. I'm just saying right here, they're maybe getting out in front of their skis a little bit with their predictions. Okay, so the all-important Cass Freight Index. I'm going to read a little bit from that as well. The shipments index actually came down a bit. The cost index actually continues to tick a little bit higher. Some of the featured commentary, it is interesting. Freight expectations. As recently as the start of this year, pricing power in the truckload market was firmly with the fleets. After nearly 2 years in this position, the concept of pricing power pendulum almost seemed obsolete to many until it swung and cratered rates. Once a pendulum gets going, it's very hard to stop. Not coincidentally, the supply-demand balance in ACT Research's For Hire survey turned loose this month for the first time since 2020 as the rebalancing drawn out by the pandemic hit critical mass. So folks, we had just off-the-chart purchase of goods. People were given a bunch of money and then they were locked up and they had an internet connection, right? So no doubt that goods demand was pulled forward. You know, stuff that would have been bought in the future was bought in the present. That's going to show up, almost has to, as weaker demand going forward, and then you're going to begin to feel that in the transportation sector. At the same time, when I sit with clients who rely on the transportation sector, it sounds like it's tight as a drum. They can't get stuff. It costs an arm and a leg. So again, you get these conflicting anecdotal signals. You know, you read the surveys, and you know, right here it says a combination of inflation, Fed monetary tightening, war in Europe, and substitution back to services from goods, as I was just saying, are all leading to a downshift in the freight cycle. And consistent with the fundamental reason for cyclicality in the freight sector, the capacity response is occurring just as the surge in demand is ebbing. While this will be good news to some, including shippers and those anxious about broader inflation, it is a sign for fleets to batten down the hatches. Far from stagflation, these dynamics strongly suggest freight rate deflation is on the horizon. Okay, so that would fly in the face of those who think that inflation is just going to continue to run hotter and hotter and hotter. Our position has been that it's going to peak if it hasn't already, but structurally there's long-term forces that are going to make it exceedingly difficult to get back to that 2% target on the Fed. We think inflation is going to be structural going forward at a higher rate than we've seen, for decades. Speaking of inflation, I hit this plenty on the written blog. This is just a chart of CPI and PPI. I'm just going to go right through that because we did that already in writing this week. Also, with regard to inflation, I wanted to show you inflation swaps. For now, we'll just define these as market expectations of inflation going forward. As you can see, it's still very high relative to certainly recent history, but notice that it's also beginning to roll over. So market-based inflation expectations in the inflation swaps contracts is coming off. This is the 2, 5, and 10 years. So the further out we go, the lower the inflation expectations are. Obviously, from what I just said, I think this is undershooting, but this ultimately, I think, has an impact on how certain markets are going to trade going forward. Commodities have come off the boil a bit when we look at the Bloomberg Commodity Index. And again, this to me is very welcome, folks. You remember, we were enjoying this very much within our portfolio. And we were sitting here saying, this is way too much, way too soon. We need some corrective action in here. China's lockdown no doubt has a lot to do with this, and you'll see a pretty dramatic decline in copper here in a second. The CRB Raw Industrial Materials Index is finally rolling over a bit right here, and that would be a good sign for those who are fretting inflation, which is just about everybody right here. And then copper has really taken the plunge. And this is probably more of a correction than I expected, quite frankly, because you know how bullish we are on copper. We'll take it, though. And really, would rather it not come screaming right back up to 10,000 bucks a ton. We'll see what happens, but our anticipation right here is that you've got China, which is probably the world's biggest consumer of copper, certainly when they're spending a lot of money on infrastructure. It was about 2 weeks ago, I think, when President Xi mentioned infrastructure, and Chinese stocks were up like 8% that day, right? But they're still largely locked down in places like Shanghai and other parts of the country, trying to squash the Omicron variant. The numbers seem to be getting a little better. That a couple of days ago, that was the news. Chinese stocks popped. President Xi is up for reappointment the second half of the year. He's going to have a much better looking overall situation. The people are going to need to be much happier than they are right now. The economy is going to have to look better. They forecast 5.5% GDP growth in China this year, and they aren't going to come close if this continues. So we don't expect it to continue, and this is not necessarily the consensus, but I think they'll find a reason to open back up, to release the lockdowns, however you want to say that, and then announce a big quantity of fiscal stimulus. And I'm thinking that'll probably be very good for Chinese equities and probably be very bullish for commodities. I think futures traders will bid copper up in a hurry on that news, particularly the infrastructure news. Okay, so folks, that's the economic update. A real mixed picture. We're not going to call a recession until our assessment says that we should. The last time we did that was August of 2019, and we began hedging portfolios accordingly, which was a wonderful thing when the market fell apart, and again, COVID gets the excuse for that recession. But our view was conditions were such that if anything exogenous hits the U.S. or the global economy, it cannot withstand it. And that happened in a big way. The fact that it was COVID, of course, allowed for the most amazing act of moral hazard, if you will, with the kind of stimulus that got brought to bear. And it basically created a situation. It was a recession that really wasn't a recession. It was the bear market in stocks. It really wasn't a bear market in stocks because none of the market clearing happened. And so we sit here with some of the same excesses, with a big cash layer on top when you look at corporate balance sheets. But ultimately, the Fed now is looking at sucking that liquidity or some of that liquidity back out of the system. And that's what has the market, the equity market upset. So we'll make that our economic wrap for the week. And now, just really quickly, all I want to do is just look at the 60-minute chart. We had this wedgie look right here. And now you can really draw one, and we still have these bullish divergences right here. So again, you break out to the top side, and then you could rally pretty hard from there based on this technical pattern. Now, in the futures this evening, stocks are rallying pretty hard globally. Now, I have no idea where we'll be by the morning, but technically, it continues to look like there may be a short-term rally in the offing. And we've had, this would be the 6th down week in a row for the S&P 500 if tomorrow's not very special. And coming off of that, we could get quite the spring, and we could get all the way back up. It would not surprise me to get right back up here and test this 4,300 level again. And that's, what is that, 7+% from where we are right now. That sounds like a tall order given what we've experienced of late. But these big, we'll call them bear market rallies. Intraday, we were down 19.8% from the peak last year, but we closed well off of that. So it's not official yet, but it sure looks like bear market action. And the biggest rallies historically, for the most part, come amid bear markets and these big counter-trend snapbacks. So it would not surprise me in the least that finally, we get something along those lines. For our purposes, really doesn't matter if that happens, but I guess my point is that, folks, when you get that, what I'm saying is we're still looking at a very precarious situation, and the longer-term trends say that it gets worse before it gets better. I just want to basically put the coming bounce, if we get that, into proper perspective. Now, if things change and conditions change between here and there, and suddenly we're optimistic and we think for whatever reason the true bottom was formed, well, we'll send that message to you, and you may see some action in your portfolio. Highly unlikely given everything that we're seeing, but of course we're always open to all possibilities. I'm going to stop there, folks. Appreciate you very much for watching and listening. I don't suspect that I'll be bothering your inbox over the weekend. Have a good one. Thanks again. Talk to you later. Bye-bye.